Thanks for clicking. Canada's headline inflation rate slowed faster than was expected in January, down to 5.9%, slower than the 6.1% that had been expected by most economists. Canada's 5-year bond yields fell on the release of the data, as investors believe this will give the Bank of Canada some breathing room, enabling it some time to play out its pause.
Things are good.
The data stands in stark contrast than that which we've been seeing from the United States, where strong inflation data has led the Federal Reserve to say it will have to raise rates further. Goldman Sachs and the Bank of America are now predicting a Fed funds rate of between 5.25% to 5.5%, or between 75 and 100 basis points higher than Canada's policy rate. And the divergent paths between the Bank of Canada and the Federal Reserve, between the pause and increasing rates, was addressed by Deputy Bank of Canada Governor Paul Beaudry at a speech last week, where, despite the Fed's previous warnings about the risks of the Bank of Canada's pause, Beaudry downplayed the risks of the divergence. But how far can the Bank of Canada diverge from the Federal Reserve before it becomes a problem? So what I want to do today is go over Canada's inflation data for the month of January, take a look at the speech given by the Deputy Governor, look at Canada's historical interest rates compared to that of the United States, and then discuss what to look for next. Speaking of next, the end of the month is fast approaching, and the local real estate board should start to release their data for the month of February within the next week or so. We'll obviously have updates out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into Canada's inflation data. As mentioned, Canada's CPI data came in lower than expected at 5.9%, down from December's 6.3%. Lower prices for cell phone service and passenger vehicles were a major contributor to the decline in prices, while mortgage interest costs and food prices continued to rise. But the real good news coming out this morning was that measures of core inflation, which strips out more volatile items like food and gas, the inflation metric to which the Bank of Canada looks when deciding whether or not to raise interest rates, also slowed, with CPI median and CPI trim both falling 0.2%. So, headline inflation down 0.4% since December, core inflation down 0.2% as well, all of which will give the Bank of Canada more room to maintain its pause at its March interest rate announcement.
Everything is beautiful. There's nothing to worry about.
With all of that good news in mind, although Canada's bond yields did fall on the release of the data, they didn't fall that much. They didn't fall that much, especially compared to the amount that they've risen on the news of higher than anticipated U.S. inflation data. So investors, at least for now, are making the bet that U.S. inflation data will have a stronger impact on Canada's interest rates than Canada's own inflation data.
I'm the one who calls the shots.
While lower than expected inflation data may give the Bank of Canada some room to maintain its pause to keep interest rates relatively low compared to that of the United States, it's not clear how long this can last. But that's not so much how the Bank of Canada sees it. During a speech given to the Alberta School of Business last week, Deputy Governor Paul Beaudry sought to address whether or not the Bank of Canada can keep its rates lower than that of the U.S.
Trade a lot with the U.S., different things. So you can kind of wonder, but can we go at it at the speed that's good for us in Canada? Or do we have to really worry what's happening in different other countries and at what speed they're coming back to their inflation target?
And on this, the Deputy Governor went straight to exchange rates, saying that if the Bank of Canada leaves interest rates low relative to that of the U.S., then our currency could either stay the same or depreciate. And if it depreciates, if the value sinks, then that could make our exports stronger, and that would help employment.
Or if it depreciates a bit, that would be the same thing. If we can get it back down faster than the others, we become more competitive, which has some of the benefits of kind of favoring more employment and different things in Canada.
On the other hand, if the Canadian dollar appreciates and gets more valuable, that will expand our purchasing power, making imports cheaper.
To kind of manage this and get it lower, we might actually get appreciation. We might not. We'd kind of become more competitive, or we get some appreciation, and that gives us more purchasing power in the world of different things.
So, according to the Deputy Governor, the Bank of Canada can indeed diverge from the U.S. and will have a good outcome either way. Either our currency depreciates and our exports get stronger, which will help employment, or our currency appreciates, becomes more valuable, which will make the price of imports cheaper.
So either way, this is actually kind of possibly good outcomes for us.
But that's not the way investors see it. As we saw earlier, investors are responding more to data coming out of the US than they are to data coming out of Canada, with investors thinking that the Bank of Canada can't diverge too much from the Federal Reserve. And there's good reason for this. Historically, over the past few decades, interest rates in the US and Canada have moved very much in lockstep, raising or lowering almost in tandem. If the Federal Reserve raises interest rates too much higher than that of the Bank of Canada, then our dollar will depreciate. And while the Bank of Canada Deputy Governor is correct, that will help our exports. It will also make our imports much more expensive, which will put upward pressure on our inflation rate. Right now, U.S. interest rates are sitting at 4.75, with predictions they could go as high as 5.25%, maybe 5.5%, and then we'll see. In contrast, the Bank of Canada is sitting at 4.5% and has signaled its intention to pause, its intention to wait and see how the inflation rate plays out. However, as history shows, it's not clear the extent to which the Federal Reserve can continue to raise interest rates, with the Bank of Canada maintaining its pause. The bank could find itself having to raise interest rates even higher if the spread between Canada's rate and that of the Federal Reserve gets too wide. While today's inflation data is definitely good news, with headline inflation coming in at 0.4% lower than it had the previous month, and CPI core also coming in 0.2% lower, we're by no means out of the woods just yet. With that said, we will continue to have updates out on the Bank of Canada and the Canadian economy and our interest rate paths going forward. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.